Welcome back to BNN Bloomberg and the Open on BNN Bloomberg. Our next guest urges caution from investors and has a novel strategy on portfolio composition as well. Robert Wilson, Senior Vice President and Head of Portfolio Construction at Picton Mahoney. I misstated your numbers prior to break. It's 40-30-30 that you advocate, and this is in contrast to the 60-40 model that investors have long understood is a good long-term positioning. That would be 60% equities, 40% fixed income. There we see your breakdown, Robert, 40% equities, 30% bonds, and 30% alternative strategies. So first of all, thank you for joining us this morning. Absolutely. Why do you think this might work better than 60-40?
Yeah, I think it's really important to understand the backdrop that we're operating in, right? So the last 20 odd years, we've had this world of very low inflation and steady inflation. And in that world, stocks and bonds are very good diversifiers for one another. They tend to diversify very well against growth shocks. What we saw last year is they don't tend to diversify as well against inflation shocks. So what we're recommending is that investors reduce their sensitivity to changes in the level or direction of the stock market, as well as interest rates, by taking 20% from stocks and 10% from bonds to build a third asset class of alternative strategies. These could be enhancers, diversifiers, or strategies that protect against inflation. The goal is to build something more resilient that can perform well across a broader range of economic scenario.
Is this a move in the direction of the portfolio composition of big pension funds, which have big investments in things like infrastructure?
Yeah, I think that's a perfect example. Institutional money has been managed this way for many years now. 60-40 is very much a relic of the past. But what's different now for high net worth individuals is access to these strategies is readily available. Whether that's diversifying across a broader group of asset classes through things like ETFs or accessing alternative strategies through things like liquid alternatives, it's now actually possible to implement this kind of thinking in your portfolio in a convenient way.
Talk to us more about what those products and options look like, liquid alternatives.
Yeah, so with a liquid alternative, we generally separate them into two categories based on the investor's goal. There are enhancers. These are strategies that are taking the same risks that are in the rest of your portfolio, but seeking a better outcome. So think about like a long-short equity strategy or a long-short credit strategy. Diversifiers, on the other hand, are seeking to outperform cash without taking the same risks as traditional assets. So these are absolute return strategies, things like market neutral or event-driven strategies. And if you thoughtfully combine these, you increase your ability to navigate a wider range of markets, and you reduce how much you get pushed around when there are surprises or shocks to the economy.
Interesting. Let's move to the markets more generally. What's your take on earnings season thus far in the U.S.?
Yeah, I think there's two key things for investors to keep in mind this earnings season. So the first is expectations. The higher expectations are, the more risk there is when there's a miss. So when you look at sectors, technology has very high expectations. If you get a miss there, you could have some risk. Other sectors that haven't participated as much in the rally this year, like banks, expectations are much lower. But the other thing we're looking at is clues for the second half of the year. And the reason for that is we think the economy is heading towards a fork in the road. Either we get a recession or we have a soft landing. And we don't have enough data yet to know exactly where that's going to go, but we could get some great clues out of the consumer discretionary sector in terms of whether they're guiding towards a slowdown in the U.S. consumer.
When I speak to people in your world, they often say, if there's going to be a recession, we think it's going to be a fairly mild one. Is that your view as well, or do you think a deeper recession is still possible?
Yeah, that's not our base case, so we are recommending defensive positioning. The challenge is that in this world of shorter, sharper cycles and higher inflationary pressure, it's not as simple as selling stocks to buy high-quality bonds. So while we are recommending reducing equity weightings and adding to high-quality fixed income, we do think you need to do more, and that's why we're out talking about the 40-30-30 framework.
Interesting. Are valuations ahead of themselves in the U.S. after the huge rally we've seen, particularly in tech?
Yeah, so this is a challenge for investors. When you look at the enthusiasm that you're seeing, particularly growth expectations, relative to economic indicators like the ISM, there's a disconnect there. And so, again, that's a risky backdrop, and we'll have to see how that resolves in the second half of the year.
The bulls say that that breadth has finally broadened out from those 7 big tech stocks. We spoke to a Bloomberg strategist just a short time ago. He says that's has been a welcome surprise to equity market investors that more stocks are participating in the rally.
Yeah, the stock market loves that it's been this Goldilocks economy, right? It's been fantastic for equity investors. The challenge is eventually the porridge can get cold. right? And so what happens then? And so the idea is you want to take your shots thoughtfully, but when there's a higher range of uncertainty, the game plan is diversification. So make smaller bets, be more broadly diversified. Don't just think about depth of diversification within asset classes, but also breadth of diversification across asset classes and strategies.
What segments of the equity market do you like the most right now?
Yeah, so in terms of investors, I'm not an equity strategist. I don't focus specifically on the equity market. What I would say is that you want to make sure that you're aligning those positions and those specific stock bets with your macro thinking. And you really need to have a view on the second half of the year as to whether it's going to be a soft landing or whether it's going to be a recession. That really is going to inform what part of the stock market you position yourself in.
Robert.